My name is Andrew Stotz, and I want to welcome you to this all-weather strategy update. I'm going to be going through the performance and talking about some issues in investing as I see them around the world, and I'll be taking any of your questions. So feel free to ask any questions that you may have about the strategy, about investing, about anything. Hopefully, you've got yourself a cup of coffee, a cup of tea, a glass of water. I had my lunch earlier, and so I'm ready to go. Also, just a reminder for those of you that are in Bangkok and want to go into more detail. In fact, I'll be at Phenomena on Saturday at 10 a.m. presenting and talking about the strategy and also taking questions. So check it out. Hopefully, we'll see you there. All right, let me get into the strategy and talk a little bit about where things are at. So let me bring up the presentation. There we go. And I'm going to go through. So what I'm going to be talking about is a review of June's performance. And remember to ask your questions in the chat. I love to get your questions. In fact, it makes it much more interesting to me. And we can meet in person even on this Wednesday, because on this Wednesday, I'm going to be doing the In 3 Hours series. Well, I'll be presenting Benchmark Your Financial Performance. You come to this event, you get a 60% off coupon from Phenomena. You can see you just use Phenomena, but more importantly, come to this event and I'll help you benchmark the performance of your business so that you can figure out how to make my business more profitable. So our allocation strategies are global and long-term, and also diversified. When I say long-term, I mean that we invest in equity with the hope that we can invest majority of our money in equity and let it grow over a long period of time. So when I'm thinking long-term, I think decades, not years. As Warren Buffett said, our favorite holding period is forever. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So remember why we are here. We're here to build wealth over the long term. And it takes determination and to stay the course. I see 6 pillars of investing. First, invest in stocks. They've generally outperformed bonds and gold, and they're offering a share in the value created by a company's management team. I like that, and I want exposure to that. Number 2 is reduce risk. Diversify your portfolio across companies, sectors, countries, factors, and asset classes to minimize exposure to any one area. Number 3, contribute regularly. Use disciplined dollar cost averaging to reduce the emotional risk and roller coaster of investing. Number 4 is stay invested. Think long term. Be patient. The benefit of compounding happens over decades. Number 5, maintain discipline. Follow your investment plan to avoid acting based on emotions. And number 6, my favorite, continue learning. Enhance your investing skills by staying informed and learning from both successes and failures. As I've said, we've created our strategies for decades, but even a decade is not really long term. There's me when I was a little kid. That's me when I came to Thailand, and that's me when I'm 100. Our aim is to create strategies that perform over many, many decades. I've outlined most of this in the book, How to Start Building Your Wealth, Investing in the Stock Market, available in both English and in Thai, in Thailand, and also as an online course. Now, before we get into that, let me just come back to you and welcome everybody here. And I'm just going to talk to you for just a second, but welcome to the presentation. And the most important thing is you. This is your chance to ask questions and understand what's happening with the strategy. And so please feel free to ask questions. Okay, so we can see Takrit says, good morning, John Andrew. I just grabbed a Doi Tung capsule coffee at the office. Okay, that's not bad. Mine is a beautiful Coffee Works, as you can see. And I'm at my home office. You can see my cute dolls that some of my students gave me. So feel free to ask any questions that you have as we go through this. You may be thinking, what about gold? What about Trump? What about tariffs? What about global trade? What about exports for Thailand? What about the Thai economy? What's going to happen? There's so many questions. So feel free to ask those questions as I go through. Just type them in the chat, and then I'll come back and try to answer them. Let's go back to the presentation. And so our target is to deliver steady returns over the long run. Now, AWS all-weather strategy, we launched it in February of 2019, and we're targeting 6% per annum. All-weather alpha focus, we launched in October 2021, and we're targeting 8% per annum. We're basically giving more exposure to the equity market in that strategy. And then all-weather inflation guard launched in July of 2022, and we target 4% for that one. Now, from when we started the all-weather inflation guard in July of 2022, the strategies are performing almost as expected. Recent rankings show moderate risk AWS is still slightly outperforming the higher risk alpha focus, while the low volatility all-weather inflation guard delivered the lowest return, but that's because we're exposing it to the least amount of risk. Now, one of the things that's pretty remarkable about this, in fact, I'll grab my pen to highlight this, is just how flat this is, right? All-weather inflation guard is meant to be low risk for those people that don't want to put much of their money at risk. Maybe they've got money in the bank and they want to earn a little bit higher return. This is it. If you just look at, for instance, here we can see the downturn in this particular period of time. And that downturn, I can't draw a straight line with my mouse, unfortunately, but that downturn you can see hit the different portfolios differently. But the key thing is that the inflation guard had almost no fall. So since July of 2022, all strategies have had lower volatility than world equity. Now, some people may say, I just want to own world equity. That's fine. You would have outperformed, but you would have had a much bigger roller coaster ride. And we mix asset classes to reduce the equity drawdowns. But this also limits the gains, right? We can see the equity market's been on a tear. We've only captured a portion of that. So now let's go into the performance of the strategies. Remember, if you have a question, ask them now. Now, all strategies are up. In fact, it's incredible that inflation guard's up 1.4%, doing quite well. And Alpha Focus was, of course, the best performing. So let's look at the first one. We talked about our all-weather strategy, 1.3% up. Now, an all-weather strategy, we're 70% in equity, 5% in bonds, and 25% in gold. And we have 0 in commodities. You'll also see that we have a 5% weighting in the US, which is very, very low. Since inception, the strategy was up 54.8% and 19.6% above a 60-40 portfolio. Here we can see AWS at 1.3% up, and we were below a 60-40 portfolio. So what happened? Our 25% allocation to emerging markets ex-China did great. And our 25% allocations to developed Europe and gold were a drag on performance. Now, the strategy has underperformed a 60-40 portfolio by about 0.4% year to date. So all-weather strategies struggled in this year. We haven't been the best that we've been in the past, but we still added value of about 19.6% cumulative. And I'm sure at some point it'll come back. The strategy did beat 60-40 by 7% in 2024. Now, let's look at all-weather Alpha Focus, which gained 1.5% in the month of June. Our equity weighting is 84%, bonds are weighted at 7%, and 9% is in gold. So here we can see that since inception, the strategy, this is all-weather Alpha Focus, was up 9.9%. and it's about 8.3% above a 60-40 portfolio. And we're about 3.4% below world equity with a lot less volatility. That's our objective, is to get rid of some of that volatility, but we know we're going to give up a portion of the return. All weather alpha focus was up 1.5%, but this was 1.2% below 60-40. So relatively weak performance. All our tilts underperform world equity. This is a great example of how you can't win them all. The month of June was a rough month. The weakest were financials and precious metals. Financials and precious metals basically flat in June. Despite that, the strategy has added about 2.7% value compared to a 60-40 portfolio in 2025 year to date. So better performance by Alpha Focus than AWS so far year to date when it comes to outperformance. The strategy beat the 60-40 by about 3.5% in 2024. And finally, let's look at all weather inflation guard. It's not meant to go up as much as the others, but it did go up quite a bit. So equity is at 30%, bonds at 60, and 10% in gold. Here we can see that since inception, the strategy was up 11.1%. That's about 6.2% above a 40% equity, 60% bond portfolio. And the strategy was up 1.4%, which was about 0.8% below the 40-60. Again, world equity did really, really well. Our tilts to infrastructure, gold, and financials underperformed. Again, it was a tough one. Now, we still had positive performance, which I'm happy with that. Global bonds gained more than tips and the money markets. And gold was flat. So the strategy has underperformed a 40-60 portfolio by about 1.4% in 2025 year to date. Remember, this is also after our estimates of fees. So the strategy beat a 40-60 portfolio by about 1% in 2024. Now, with the all-weather inflation guard, I don't expect to beat the benchmark by much because we're not putting a lot of risk into it. Now, before I move on to the next thing, let me just go back, and if you've got any questions, now is a good time to ask those questions. So let's see if we can get me back up on there. Hold on. There we are. So my camera's a little funky, so I'm going to switch it to that one for a second. All right. So the first question is, in AWS, is there any difference between emerging markets ex China and Asia ex Japan, China, Hong Kong? Yes. So the emerging markets ex China includes emerging markets in South America, emerging markets in Europe. So that's global emerging markets. And then China is just excluded. Whereas Asia Pacific ex Japan is all of Asia, excluding China. That Asia Pacific ex Japan, ex China, ex Hong Kong is the one that we created at Thales. And we created that so that we could have exposure to Asia without having exposure to China. And so, unfortunately, it ran very well, and we didn't have exposure in this particular time. So that's an answer to that question, Chalernpat. And feel free to ask any other questions that you may have. Also, some of you may ask when we're going to rebalance the portfolio, and the next rebalance is about at the beginning of September. So we'll be working on it at the end of August. Let's go back to the presentation, but before I do, feel free to ask any questions. I'm happy to answer those questions. All right, let's see if we can get back to the presentation. There we go. Hold on. So this is the case for emerging markets ex-China. So Chalernpat, this will answer a little bit of your questions. So global inflation is still above the long-term average. It's at about 3.1%, despite tariffs and all that stuff. This could mean that interest rates stay high for longer, and high interest rates usually put downward pressure on stocks, even though stocks have done well in this particular hiking cycle. Incredible amount of hiking that's going on, and the stock market still runs. Now, both worlds, emerging and developed, are above their pre-COVID inflation levels. But you can see emerging world has a much higher level of inflation than the developed world. Now, emerging markets 10-year yield has returned to pre-COVID levels, while developed market is significantly above. So what you can see here, and I think this is a good example of the difference between emerging and developed, is that, first of all, there's a huge gap between emerging and developed. The developed countries have the benefit of being able to issue debt at very, very low levels, but emerging market debt is going to be higher. But you can also see when you look at this that there's very little movement of this, whereas this has gone down almost to zero and then popped back up. So there's a lot less volatility in the emerging markets. Now, normally you would think there's more volatility in emerging markets, but not in bonds, because remember that these countries are all issuing their bonds. They may be in US dollars in some cases, in most cases, but basically what's happening is that interest rates never went down super low in the emerging markets, whereas the developed markets, because of their control over the monetary system, they basically can lower their rates extremely low. So US, which is the largest market in developed markets, still faces higher than normal inflation. This is a comparison of China and the US, and it's just incredible what's happened in China, where we're now in a situation where inflation has been negative, while America is still relatively high at about 3%. And so there's been, it's China is really in a struggling place when it comes to their economy. So while China, the largest market in emerging markets, is challenged with deflation, I think this is where it comes back to the question when we're investing in emerging markets globally, that, when the Chinese economy is not doing well, it could be that we have less exposure, and it's better to be having that exposure in emerging markets around the world. So the US is keeping rates high while China is lowering rates. China has been reducing its 10-year bond rates consistently, and with the lower growth in the economy, the rates are coming down in China. So China's doing its best to stimulate a weak economy, bringing interest rates down, trying to stimulate the economy, trying to do government spending is, a big item in China. Of course, the problem that China faces is it also, just like the US, has a huge amount of debt. So the US tries to manage inflation pressures while some weaknesses start to show in the US economy. So let's take a look at unemployment here. US unemployment is on the rise. We can see a small uptick. Peak employment precedes recessions, and when the unemployment starts to rise, historically, a recession has followed. Now that rise is very small right now. Basically, there was a lot of people knocked out of the workforce during the COVID time. Now, credit card debt is now over $1 trillion and growing, while past due bills have risen. So the consumer loans or credit card debt is the red line we can see, and the delinquency rate has actually come down a bit. It had risen quite a bit after COVID, when people were really, charging their credit cards, but now it's starting to come down a bit. So that's somewhat good news for the US, which is already, I would say, under a lot of economic pressure, just like Thailand is. And US debt has grown by about 2 times as much as GDP since 2000. The real divergence started with the global financial crisis. The big beautiful bill is likely to grow the debt of the United States. And given the high interest rates, US debt service definitely becomes very expensive. And unproductive budget deficits are unlikely to drive the US economy. So we have a difficult situation right now, because what's happening is that the US economy is, let's see if we can get me up there. There you go. US economy is facing, a down cycle right now. And yet interest costs are high, government spending's high, it's very hard to stimulate the economy. Now, I would argue that's part of the reason why the Fed has kept the interest rate relatively high, because number one, they're concerned about inflation, but eventually, if the economy starts to do poorly in America, then they at least have the ability to lower interest rates a bit. Whereas in China's case, they don't have that tool because interest rates are now close to zero. So the result is that America does have the ability, and that's why you see Donald Trump putting pressure on the Fed to lower interest rates, and eventually he's going to get what he wants with that. Let's go back to the presentation. Feel free to ask any questions that you have. Now, China's indebtedness has surpassed the U.S. This is credit to the non-financial sector, meaning credit to companies, not credit to banks, let's say. And we can see that China is now 287% of GDP, which is in excess of the U.S. So the world's second largest economy is also highly indebted. Now we've kept our U.S. target allocation at 5% in our June revision, even if it turns out that Trump is not authorized to impose tariffs or decides not to do so. It hurts global relationships. AI and tech stocks may suffer as semiconductors could be affected. In fact, it's hard to see how they wouldn't be affected. It appears that the market expects that the U.S. will avoid a recession, which constitutes a risk if the Fed fails to avoid it. Now, we think the risks outweigh potential upside scenarios in the U.S., and that's part of the reason why we're at the 5% allocation. Now, we reduced our China equity target allocation of 5% from 25% in the June revision of the strategies. While tariffs have been paused, the U.S.-China trade war is far from over. Concerns about a weak Chinese economy and deflation remain persistent, and we no longer find the risk-reward in Chinese stocks attractive. They may come back. Again, we're going to look at our strategy again in September. Now, emerging markets ex-China has underperformed for years. That's the line at the bottom of this chart that I've shaded, so it has a little bit of a shadow around it. And it's been underperforming for a long time. We think it's time for recovery, and we've added a target allocation to the region of 25% in the June revision. In fact, the gap between the U.S. market and emerging markets is huge. Now, developed markets trade at 19.5 times PE, which is more than one standard deviation above its long-term average. This chart is great for us to try to answer the question, is the U.S. or is the world in a bubble? Well, here we can see the developed markets, which is mainly the U.S. And I would say we're not in a bubble for two reasons. Number one, we're only a little bit more than one standard deviation above the longer term average. But the second reason why I would say that is because we know that the US in particular is propped up by a small number of highly valued tech companies. And the rest of the market is much, much lower on PE and price to book. And so it's hard to say that the US is in a bubble when it's really the top 10 or 15 companies that have been enjoying almost all the gain. Now, here's the emerging markets. And what we can see here is that emerging markets still are below one standard deviation from the mean, but yes, they are rising. And that's the rise that, I think as the US gets more and more expensive, we're going to see that emerging markets continue to become an attractive place. Now, the problem with emerging markets, though, and the reason why money's not rushing back to emerging markets is there's not much growth in emerging markets and the profitability is not that high. So emerging markets trade fairly attractively relative to its past. It trades significantly below the developed markets 19.5. Let's talk about the Fed. Now, the market expects higher rates for longer in the US. Right now, we can see the probability weighted Fed target rate is about 3.2 by December of 2026. But as of right now, it's 4.5. Now, this reflects concerns of returning inflation and also that investors demand higher rates to buy U.S. government debt, which shows in the rising yields. At some point, Fed will cut rates, which puts further downward pressure on the dollar. Now, I want to talk about this for just a second. So let me go to the screen here for just a second. And I just wanted to talk about the idea of what's happening with U.S. dollar and interest rates. So right now, the interest rate on long-term bonds in the U.S. is quite high at, let's say, 5%, 4.5%, 5%. And the result of that is that it keeps the dollar relatively strong. But if we see that they really do reduce the interest rates, we could see that there's weakening in the dollar. Now, of course, I would not bet against the U.S. dollar because I know that in difficult times, what happens is money moves into the low-risk asset, which is the U.S. dollar. And so I would be careful with that. Let's go through a couple questions. And if you have questions, feel free. This is Banang and Bunang. Okay. Your perspective on global equity, especially B Global. Well, B Global has done very well. It's, I would say it's generally been managed very well. And global equity, to me, is not that expensive compared to U.S. equity. So if I was allocating purely between global and U.S. right now, I would be more comfortable putting more of that weighting into global. Of course, if the U.S. comes down or crashes, global is going to come down too. But I would argue that global is a lower PE, lower valuation. Saranya says the return of investment on mutual fund and long-term bond in 1 year back, the return rate is already 4 to 5%. So, yeah, I mean, if you have, let's say a year ago you were holding bonds, you were getting 1%. Now you're getting 4 or 5%. Let's say, for depending on how long the term of the bond is. But let's just say from 1 to 4%. But of course, if you were owning that, the value of that bond would actually go down as the interest rates are rising. So it's a little bit tricky. You've got to be managing both the yield and the return on the bond. So let's see. Hi, John Andrew, OBBB MAGA, really? I don't know what that means. OBBB MAGA, really? What does that mean? Help me. All right, let's go back into the presentation. I'll talk a little bit more, but ABB, you need to come back and tell me what you're telling me. Okay, so now remember that a weak US dollar, which we've seen the US dollar getting weak recently, benefits emerging markets. And with Trump's tariffs, rising government debt, and a weaker US economic data, we expect eventually the US dollar is going to be weaker. But it's so hard to bet against the US dollar. But ultimately, emerging markets should have a good 5 years ahead of us of returns. So let's recall why emerging markets benefit from a weakening dollar. Many emerging markets have significant dollar-denominated debt, and a weaker dollar makes it cheaper for them to repay this debt in their local currencies, freeing up capital for growth. Also, a weaker dollar makes emerging market assets more attractive by boosting potential returns from local currency appreciation, easing dollar-denominated debt burdens, and increasing commodity export revenue. Many emerging market economies are major commodity exporters. So as commodities are often priced in dollars, a weaker dollar typically leads to higher commodity prices in local currency terms, boosting export revenues and economic growth. Now, the top 4 markets account for 65% of the market cap in emerging markets ex-China. So this fund that we use is active and currently overweight Korea. These 4 countries account for 65% of the fund. In parentheses is the weight in the master fund. So we can see overweight and underweight. Overweight Korea and overweight Brazil right now. Underweight Taiwan and underweight India. This is what's happening in the fund that we're investing in. Now, India trades at the same level as the U.S., on a cyclically adjusted PE. So we can see the US in red and India in green, almost the same. The fund we use underweights India and Taiwan relative to the benchmark, and still 34% of the fund's NAV is there. The fund overweights the two cheap markets, Korea and Brazil. Now, through semiconductors, emerging markets benefit from AI, EV, and tech optimism. Korea and Taiwan, of course, are first and third largest manufacturers of semiconductors globally and account for more than a third of the emerging markets ex-China index and the fund that we use. Now, Taiwan is one of the fastest growing economies in Asia. You can see GDP growth in the last 4 quarters was about 7.7%. Taiwan is second largest weighting at 18% in this fund. We think Taiwan can continue strong. Still, we like that the fund has its largest weight in Korea, which is only the third largest market in the benchmark. Here we can see Korea returned to a trade surplus in February of 2025. And a positive balance of trade means Korea is exporting more than it's importing, which is a good sign for an export-driven economy. Korea's semiconductor exports are up 7% year on year for the first 5 months. Korea is the second largest semiconductor producer in the world, and AI momentum brought back demand. In 2024, Korean semiconductor exports bounced back by about 30% year on year. Now, always remember there's a Korea discount, but it could be reduced by their value up program. Like Japan, many Korean companies trade at a long-term discount to global peers. The Korean Financial Services Commission and the Korean Exchange have launched the Corporate Value Up program to attempt to reduce the Korea discount. It's not going to be easy, but like Japan, Korea wants companies to disclose plans on how to reduce valuation discounts, launching the Korea Value Up Index composed of best practices companies. And KRX is to set up a dedicated department support system and advisory board to help implement and improve the Corporate Value Up program. The Korea Value Up Index constituents should be companies with proven records of profitability or those anticipated to boost their corporate value. The primary purpose is for the index to serve as a benchmark for institutional investors, including pension funds. It can also serve as an index for ETFs to track. Korea's National Pension Service, the world's third largest pension fund, is expected to use the Value Up Index as one of the benchmarks for its external asset managers. NPS may also allocate some of its assets that are currently invested in other indices. So speculations are that more than $8 billion could be invested in the index by NPS and its external asset managers. Now, India's economy grows fast, but it has been reflected in a very high valuation. We can see the bar at the bottom shows GDP at 8.23%, driven mainly by investment and also by private consumption. India is the third largest weight in that fund and still a significant underweight compared to the benchmark of 28%. India is strong and can continue, but given the rich valuation, we like the fund being underweight India at this point. Now, Brazil is positioned to do well. Only about 20% of Brazil's GDP comes from exports, which means the market should be less sensitive to the trade war. A weaker US dollar typically is positive for commodities and should benefit Brazil's resource-driven economy. Unemployment has fallen, and that's pretty impressive for Brazil. And we can see at a 15% policy rate, there's room for further rate cuts. So the interest rates in Brazil have been, relatively high to try to control inflation. Inflation has come down to about 5% from 11%, but still above the 3% target. So rate cuts in the next few months would be a positive surprise if they happen. So we have 25% target allocation to emerging markets ex-China in AWS. US and China face different challenges and are in constant conflict. So we're looking to emerging markets ex-China. And weak dollar benefits emerging markets. And through semiconductors, emerging markets benefit from AI, EV, and tech optimism. And the fund we use overweights Korea and Brazil, which both appear attractive. Now, before we get to the Q&A, and feel free to send in any questions you have, we're launching boot camp number 22. That starts on the July 21st. So maybe yourself or your children can attend. We help finance professionals become valuation experts in months rather than years. We have many previous attendees coming from phenomena such as Chachada, Tosapon, Takon, Jutamas, as an example, and Bunsim, as well as Pongsakon. In the Valuation Masterclass Bootcamp, you get a 12-week guided intensive online valuation bootcamp, daily live sessions, team support, progress tracking, and you write and present a professional valuation report. Get an extra $100 off at any price point and great bonuses by using the Phenomena coupon code. Just go to valuationmasterclass.com/bootcamp or scan the QR code, and we'll see you in the bootcamp. All right, let's look at any questions that you may have at this point in time. Feel free to type your questions into the chat, but let's see if we've got a question here. If I invest in UGIS-N now, what would your opinion be? Actually, UGIS, I don't know which one that is. You got to tell me which one that is. I'm not good at all those codes. 1BBB, Trump bill. It's really good for Make America Great Again. I would say the Republicans are in a very difficult and strange position. On the one hand, they want to try to, some of them want to try to reduce government spending and reduce the debt. But then Trump comes up with this big bill. But the point from Trump's perspective is if he doesn't get the funding, he can't do his agenda. So in a sense, the Republicans kind of had to go along with it. The question is, what's going to happen for the next budget? And the problem that they face is that if they cut the next budget significantly with the objective that they want to bring the deficit down and the debt down, the problem that they're going to face then is it may be harder to get reelected in the midterms. And if they lose control of the House and the Senate, then it's going to be hard for Trump to get much done. So it's a mixed bag. I wouldn't say it's overly positive, but I would say if Trump hadn't have gotten the one big beautiful bill, it could have been harder for him to implement his policy, like the funding for ICE for his deportations that he's promised his voters. All right. Pony Taro says, what do you think about high yield income ETF using options? It seems to have been making quite a noise recently. That's too complicated for me. I try to keep things as simple as possible, and I do that by mainly holding equity. So also, I'm not particularly interested in options. If you find yourself very interested in options, then, check it out and play with it and see what you can do with it. Also, one of the lessons that I've learned in my career is stick to what you really like. If you like options and you think you can make money on it, try it and see. For me, I prefer equity. And I know for my investors, people that are following this strategy, I want to keep it simple for them and not complicate it with Bitcoin, not complicate it with options. Termsock says, hi, Andrew, just optimization of my port. Yes. And for retired. Yes. So for retirement, your picture looks so young, but for retirement, I like to focus on all weather strategy just because that's such a protecting against downside. And, for retirement purposes, you don't necessarily want to get as much upside. You want to prevent the downside. So that's, one thing I would say for that. But of course, for all of the things that I talk about, I'm not an advisor and I'm not your advisor. So you make sure that you talk to your advisor, talk to the advisors at Phenomena, and hopefully they can guide you on that. All right. It looks like we've run out of questions. So it was a underperforming month of June, but we still had an upside. So I'm happy about that. But let's see where July gets us. Again, for those listening, we're going to be rebalancing basically at the beginning of September. That will be the next rebalance. But until then, what I like to do is basically focus my strategy. Once I've invested in the strategy, just let it go. You're going to have some underperformance. You're going to have some outperformance. Pony Tower says, I put like 5% there. The yield's very high. Yes, but 15% tax is pretty harsh. Yeah, I mean, I would just be very careful. You know, the question is, what are you trying to do with it? If you're trying to gain from high yield, for instance, let's say you think there's opportunity in high yield, you know, in theory, you should be able to get a reasonably similar type of gain in stocks and not have to go to high yield. But I don't know enough about what instrument it is and the details. So let's see. Good. Well, I want to thank everybody for coming in, and I will see you in a month. I'm going to go see my mom. She went for a long walk at Lumpini Park this morning. So she's feeling strong and rested, and I hope that you and your family are feeling good. Meanwhile, remember, why are we here? We're here to build wealth over the long term. So let's keep our long-term focus, and I will see you again in a month. We do have another question. Hold on one second. Realm Hopping says, seems that AWS performed a lot better than AWAF. Shall I switch? I wouldn't switch. In fact, what you just saw was AWAF perform relatively well in the latest period. I don't think there's a strong reason to switch. You know, I was asked this question recently by someone else, and I was saying that, you know, there's just times that one strategy is going to outperform the other. And the question really, when it comes to all-weather alpha focus, is, are you comfortable having a higher exposure to the stock market? Because the equity exposure in all-weather alpha focus is going to be higher than all-weather strategy. That means sometimes we're gonna miss it, and the performance is going to be down. But it also means the performance is going to come up and be significantly higher than AWS at some point. But if you're feeling that you can have the higher exposure to equity, you've got a long time period, I would say that all-weather alpha focus is going to have more exposure to equity and more exposure to smaller equity funds that can potentially have performance. So that's how I would answer that question. Term Suck says, I try to test asset Bitcoin 20%, SPMO, ETF 20%, commodity 20%, gold, Japan short bonds 20%. What do you think? It's too fancy for me. I think that a couple of things that I would say. The problem that you face with this strategy, now I don't know your situation, and it may be perfect for you, but for me, when I look at that strategy, there's just not enough equity exposure. And I think that equity exposure is the core of a strategy. For instance, looking at commodities. Commodities have never really been a great long-term investment except in inflationary times. Now, you'll see that I go up to as much as 25% in commodities at the highest level, but right now it's either 5 or 0. So I think your commodities is quite high unless you have a very strong thesis that you see inflation coming. Gold, yeah, you know, gold has been great, but remember, before the run in gold, gold was an underperforming asset class for many, many years. So I would say, you know, at some point that gold position probably is going to need to be reduced. Japanese short-term bonds, I'm assuming you're saying short-term bonds, or are you saying short bonds? I'm not sure, but that's a lot to have in one country bonds, and in particular in the currency. I don't know if that's hedged or not. So for me, I would say more equity exposure. Now, I don't know what SPMO is, so I'm not an expert on all the ticker codes on all those things, but I would say that would be my feedback on it. 20% for Bitcoin, that just depends on your risk tolerance. And if you love it, you know, I would never say to someone, don't own something if they really think it's a great, you know, opportunity, but that's a pretty high level for Bitcoin. actually what we should do is, share your strategy and I'll look at it. But that's my feedback for that one. All right. Well, it's great seeing you all, and I hope that you have a great day and that we have a lovely month. I'm looking forward to July and enjoying it. It's my favorite month of the year because it's my birthday month. So, all right. Thank you. And I will see you in 1 month from now, or I'll see you on Wednesday at the Landmark Hotel, or I'll see you on Saturday at Phenomena. Have a great day.